Hey, this is Tish Griffin, and I am back again on behalf of Family Credit Management Services to talk with you on any questions that you have regarding debt, finances. If you've got any problems that you're going through dealing with debt, this is the place for you to get help. You can reach out to Family Credit Management, who has counselors standing by as you watch this, that you can reach out to and get the information that you need. So reach out to Family Credit at familycredit.org or call 800-994-3328. And again, use this as a trusted resource, because right now, a lot of times we don't know where to go for help or trusted help, and you need an unbiased opinion that can help you get everything back on track. So reach out to those counselors. Be sure that you use them as your trusted resource. And again, we're back to talk with you on finances and answer those questions. So today I wanted to start with a lot of questions that I've been getting lately. So we're going to go over some of those, but they really have been focusing around the Federal Reserve meeting that just happened, that just concluded. So with that being said, the Federal Reserve, they get together a few times during the year, and they've got about 2 more times to meet before this year is over. They're going to meet again in October and again at the end of the year. And when they get together, now the Federal Reserve is not a bank, but they do help to outline the policies that the banks must follow. So when they get together, what they do is just really go over how is the economy doing. How does it affect consumers, and how does it affect the banks and those people that actually need to use them? So they kind of dictate the policy or what's going to happen. And when they're looking at everything that's happening, and we are feeling it here, because right now we don't know what to do with our finances. I've got consumers that are reaching out saying, hey, I can't make it. I don't know what to do, or I want to start thinking about the future, making sure that I have enough saved. I want to make sure that I have things in place. And so you want to take some time and get those things together, but it's all based off of the economy, and our economy has been all over the place with all of the different changes going on, be it political, social, economic. All of these changes, they play into the finances, and they play into what we as consumers can and cannot do. So we want to make sure that we understand how these changes affect us. And so that's what we're going to talk about just for a little bit today. We will focus on what happens when the Fed meets and they go ahead and make changes. So the most recent change that just happened, it was just announced, is that the Federal Reserve has decided to cut or to reduce rates by 1/4 point. And so a lot of people think that, oh wow, they're reducing rates, and this really does have an effect for us. What does this actually look like in the course of a month? When you say that you're going to reduce rates, how does it affect me? Does it affect me ongoing? Is it affecting my budget? Does it affect me for the full year? What's going to happen? And does it mean I'm making more money? Does it mean that I'm spending more money? What does it actually mean? So when the Federal Reserve, when they set out and they lower the rates, it actually lowers the cost of borrowing. And so with that being said, when we go out and we try and borrow, we should be able to get better rates. We should be able to get certain perks, or the policies have been loosened up just a little bit to allow us to be able to get some of those things, or to finance our options, dreams, things that we're thinking about doing. And we don't want to go crazy. Remember, we want to always use our credit responsibly, right? So how are we going to do that? First, let's think about this. How does a 1/4 point percentage rate reduction affect the way we use credit? How does it affect our debt? Well, with that, think about this. Variable rates, or the rates that go on the credit cards, they're really pretty much tied with the rates that the Federal Reserve puts out. And when they reduce rates, first off, when the Federal Reserve reduces rates, that's not saying that they're reducing your interest rate per se. What they do is they reduce the rate for the actual bank to borrow money. Now remember, they aren't a bank, but they set the policy. So what happens is a bank will go to the Federal Reserve to get more money to loan out to consumers. So it takes the money that the banks themselves, that the finance companies, that everyone needs to borrow from. It takes that rate and it reduces it. And what we want to see is that when that happens, the savings are passed down to us. So when you're looking at your credit card rates, if the Federal Reserve has reduced rates and that rate goes down, that means that your interest rate should be reducing as well if you were to apply for credit or go apply for a credit card. That means that your balances should actually be calculating as less now, because now you're not paying such a high interest rate. With that being said, it's only a quarter point, but we'll talk a little bit later on in the show about what those actual numbers mean to you, because that's important for you to understand. I could say quarter point all day long, but unless I tell you how it relates to your budget, it really just means nothing. So we're going to take a look at that as well. Now, not only does that mean that the rates that your balances accrue less interest, but think about this on personal loans too. When you go and you get a personal loan, you have a set interest rate. If you were to get a new loan right now, that means that rate will be lower than what you previously qualified for, which is a great thing. So if you were to take this current personal loan that you have right now and try to refinance it, then you should be eligible for a rate reduction there too. Now, keep in mind, when you do the personal loans, we've got a start date and we've got an end date. It also depends on what that end date is. So if you're really close to it, you may not want to do that. You just want to make sure that you can, again, afford the monthly payment. You know what that rate is going to be, and you know your time in and your time out. When will that loan be done? And figure out if that works for your budget. And that should really determine whether you refinance or not. Now let's think about the big push that people think as soon as they hear that the rates are going to be lower is we think about mortgages and how it affects our housing. Because yes, if the rates are reduced, the mortgage rate is actually tied to that as well. So we see the same shift with the mortgage rates that happen. So if the rates are reduced, then you qualify for a lower mortgage rate now. Again, it's only a quarter point, so it's not that much, but it's enough to make a difference. So you want to think about it. Short term, you'll see that adjustment. You'll see if you were applying for a mortgage last week, you should be able to tell the difference. And sometimes it just means that you don't have to pay what's considered a point or a percentage more. Sometimes the amount that you have to bring to the table is reduced because of this as well. If you're looking to get a home equity line of credit, or you have a home equity line of credit and it has a variable rate and it's tied to this loan with the variable rate now, let's say, and it's coming up on your adjustment period, your loan is getting ready to adjust and your interest is going to be adjusted with that period, now your rate should be less. That means that your monthly payment is going to be less. And that is a great thing because it really does work in your favor here. So if you've got that home equity line of credit or you got that home equity loan and rates have just been reduced, now your monthly payment should actually decrease. A lot of people are looking at getting auto loans as well. As things have been changing, we find ourselves needing an auto. And nowadays, people are typically buying a car when they need it, not just because they want it. So with that being said, car lots have these inventories. You're applying for a loan. Now your interest should be smaller as well, meaning that your monthly payment for a car should be more affordable. So if you're looking, you may want to start thinking about what that monthly payment looks to you. Look at your budget. Look at what you're paying now. See, can you afford the payment that you're paying now? If that payment were to double, is that too much? you need to know what your range is, because nowadays, again, cars are more expensive than they've ever been before. It was not too long ago where you could find a decent car for about $12,000 or less. Now, starter cars coming out a lot more than that. I've seen some starting at like $20,000 or more, which means that now you've got a higher balance that you need to pay off. So we want the payment to work with the budget. What if the finance companies decided to do? They've decided to change the terms when you get an auto loan. Years ago, you would get an auto loan for 36 months or so. That means you're paying that car note for 3 years, right? Now when you go to auto loan, because the balances or because the cars cost more, guess what? They've decided to change the way that these autos are financed. And now you're looking at sometimes not just a 3-year loan. You may have a 6, 7, 8, or even a 9-year auto loan term. And for some of us, that's a lot. Do you really think you're going to be driving the same car for the next 9 years? So you want to think about that. With that rate going down, now your term should be different. You should be able to finance that car at a cheaper rate, and your monthly payment will be less. So really check that out. If you were looking at buying a car last week, you may want to look now that the rates are down a little bit lower. It should work in your favor. Another thing that we want to think about, which not a lot of people think about, now that the rates have been reduced, how does it affect your actual bank account? For a lot of us, we throw money in savings, or savings are looked at as our secondary account, and we're trying to save money and make ends meet. So we think that the savings is the perfect vehicle for that. There's also other products that will help you save that your bank can help you with, and you can ask about, such as CDs, money market accounts. So you do want to look at what way can you save. But now, with rates being reduced, that also means that the rates on your savings will now become less. So you want to think about that. The savings rates, they're really closely tied to the Fed rate. And so rate cuts, they tend to boost the investment market only because the borrowing is cheaper, but on your bank account, you earn less. If you've got any questions about this and how it's going to be affecting your budget, I do want you to reach out to a counselor at 800-994-3328. You can also go online to familycredit.org. The best place for you to take all of this information and everything that we're talking about is to put it into your own daily practices. See how it relates to you. Put it into your finances. Let's look at doing your budget, your spending plan, and see how this actually works for you. We're talking about how does the federal rate cut, how does that really affect your budget? Again, when we're looking at savings, yes, you're going to be saving less now if you have those types of accounts. A lot of banks pay a percentage for you to save your money in the bank, and sometimes they do it on the checking account as well as the savings. So when you're thinking about it, a lot of the accounts now, your rates are like between 2 and 3% on a regular traditional savings or checking account. Now, if you're looking at earning more, then you can possibly look at some online accounts. I think there's some online accounts that pay more than that. Some pay double, but you've got to find that, do the research, look for it on your own. And also keep in mind that now the savings accounts, the amounts that they're paying out is going to be less. I've seen some where they're going like, if they've got a 2%, now the banks are going to be offering like 1%. Or just keep that in mind, because we're looking at different ways to increase our budget. So on one end, the amount that you're putting out is going to be less, but the savings amount that you're bringing in is not going to be as high as it was. So we want to keep that in mind and make sure that we're working on our budget all the time to make that work for us. Now, with that being said, we're seeing the amounts that we're saving. We're loving that amount. We're bringing in the same amount, but now we just need to adjust our budget for that, because inflation is still happening. But hopefully the lower rates will encourage more. What they're trying to do with the rate cut is encourage you to spend more, encourage you to borrow more, so that they can generate more within the government as well. and it supports the economy. But again, we want to think about, how does this actually relate to me? So the bottom line for us with this rate cut, how does it affect us? Borrowing will become cheaper. Borrowing is cheaper now than it was last week or a few months ago. So borrowing is cheaper. Keep that in mind. But your savings will be less rewarding. Our bank accounts are just going to really pay out less than they were before. And you're thinking, a lot of times you see that on your monthly statements where it's just a few pennies here and a few pennies there. It's going to be less. But your spending power can now increase because the rates have been cut just a little bit. So let's think about this. Let's put this into actual numbers. Let's give some scenarios so that you can see how this affects your actual budget. So let's think about it. If you have a mortgage and your mortgage rate was 6.5%, and with this rate cut, now your rates are going to 5.5%, right? You want to refinance because rates are lower. This is the way that you do that. You go to your lender, find another lender, see if they can refinance this loan for you. And they came back and told you, yes, we can refinance you. You're at 6.5. Now you're going to a 5.5. What does that look like in numbers for you? That means that overall, you can save $160 or so per month just from that small little adjustment. With you refinancing, yes, you may be extending your time out, because when you get a mortgage, typically mortgages, the term that people tend to choose is a 30-year mortgage. So we're going 30 years. When we refinance, we're starting that loan over. They're essentially taking that mortgage that you have, paying it off, and giving you a new one at this lower rate. So with this lower rate of 5.5%, now your monthly mortgage payment will be about $160 less. So think about it. Is that worth it to you? A lot of times, yeah, it is. That's a nice savings, $160 off of what you're paying. If you are struggling to make your mortgage payments as well, another thing that you may also want to look at is, can your insurance be adjusted, your homeowner's insurance? So if you're getting a refinance, see if there's anything that they can do on that too. That may bring you some extra relief there. So now you've got your mortgage payment down, your principal and interest will be less, and your homeowner's insurance may end up being less as well. So those are some ways that you can save. But again, if you keep this in your mind as a rule of thumb, if you had a 6.5 and you're going to a 5.5, now your savings is roughly $150 to $160 per month. Okay? And that's how you make that decision. Thinking about it. Is it worth it now? Should you wait? Should you refinance at a later time? Should you just worry about keeping things like they are and making your mortgage payments? That's really up to you. But keep in mind that if you do decide to decrease your mortgage payment, if you decide to go ahead with that refinance, because it is going to be saving you, and right now you may need that relief, but when you are able to adjust your budget, let's say you pay off your debt, you come into a lump savings, a lump sum reward, some sort of way, you get a bonus at work, you can pay extra towards it to reduce it even further, to reduce that overall debt. But right now it's about reducing your monthly payment. And then when you want to, and when you're ready to increase that monthly payment, you can, and get that debt paid off just that much sooner. So keep that in mind when you're thinking about your mortgage. Now, how does this rate cut affect credit? How does it affect debt? Well, I'm going to give you this example. Okay, let's say you've got $5,000 in credit card debt, right? $5,000. And you were at 20%. And 20% rate, depending on where your credit is, usually a starter rate would be about that. I've seen some starter rates at 28.9% or even higher. But you want to make sure that you're budgeting those payments out. So let's say you were at 20% and now you go to 19%. Just that little bit of change right there. If you got a variable rate card and it adjusted just that little bit, 1 percentage point, you're saving roughly about $50 per month based off of that $5,000 credit card balance. Again, it's just putting things in perspective. Now, if you are struggling with your credit cards, if you need a little bit more relief, if you don't know where to go, what payments to make, you don't like dealing with your creditors, you haven't talked to them, but you're struggling and you need some help, reach out to a counselor at familycredit.org or call 800-994-3328. The counselor's there. The counselors are there to help you. They know the creditors, know what they will and won't do. And again, like we're talking about these rates adjusting on your credit cards, they can tell you or go over what these creditors will do, what their policies are, if they're more likely to help you, and what type of help you can get. How cool is that? Especially when we're struggling with that and we don't know what to do. Again, we want to think about that. That's a great way for you to save. But again, if you've got a variable card or you're looking at getting a new card too, this might be another avenue for you. Let's say you've got that high interest card, but you're also getting offers in the mail for a lower rate. And that's going to happen now, especially with the rates being reduced. You're going to probably start seeing more offers, but at a reduced rate or at a rate lower than what you may already have. So you might want to look at doing a balance transfer from one card to the next to capitalize on that savings. Again, that's about a $50 savings if you're looking at a $5,000 balance. Just that adjustment of 1 percentage point can save you that $50 per year, okay? So keep that in mind. The same thing with the car loan. Let's say you went out and you looked at getting a car last week. They came and told you, hey, we can give you an 8% rate. And you didn't take that offer, but you still want to get the car, but now their rates have adjusted. And now you go back to them and they offer you a 7%. And you may say, well, that's just 1 percentage point. But think about it this way. That 1 percentage point can save you like $10 to $15 per month. And let's say the rates are even better than that. That's going to save you more. You're not putting down more. You're not doing anything more than getting a better rate. So if you are in negotiations for an auto loan, it's definitely okay for you to reach out and say, hey, can we do something about the rates? I know rates just adjusted. I need a little help. And they will do what they can to get you down. Again, if you've got problems with that or dealing with your creditors, reach out to a counselor at 800-994-3328 or go online to familycredit.org. Now, here's the flip side of that. We talked about how these things are helping when we spend and when we save in our monthly budgets, but when we're actually saving, now what does that actually look like? So let's say for your savings account, you've got $10,000 in the bank and you were getting a 2% interest rate on that $10,000. Now they take your rate to 1%. And that means now that within a year's time, you'll be earning $100 less because that interest rate reduced from that 2% to 1%. Again, the savings is less now, but your spending power, your buying power is more, and you're able to capitalize on that and save in your monthly budget because now you can capitalize on those rates. You can capitalize on what that Fed cut just did for you. And so that's why we're here to give you that information. You can look at how that will affect your budget. Reach out to a counselor. Go online, familycredit.org, and I want you to pull down my spending plan. That's something that you can print off, you can download it, and you can use that copy to start filling in your budget and see what it is that you need to do to reduce your monthly spending and capitalize on these deals. If you're thinking about refinancing, reach out to a lender and see what that looks like for you. If you've got that mortgage, call your mortgage company and see if this is possible. See what they can do to refinance you. A lot of times your mortgage companies want to keep that business going. They want to keep you in the house. They don't want your house. So if you are looking to refinance, most likely they want to help you if you qualify. And the way for you to make sure of that is to reach out, get the information you need, see what your new payment will be, and they can help you with that. Again, auto loans, looking to capitalize on that and what that interest rate may look like for you. If you were at a higher interest rate, now you can be at a lower interest rate. Your monthly payment should be less. But let's say you're stuck in an auto loan right now, you can reach out to your current lender, your current servicer or provider, and see about refinancing and see what your lower monthly payment would be. Keep in mind, when you do refinance, we're resetting that term, we're resetting that time frame, and sometimes we can make adjustments on it too. Maybe we were in one of those 8-year auto loans, but now we want to take it and change it to a 5-year or 6-year because the rates have been reduced. And with that being said, we can refinance out of that. But the only way for you to know is to reach out to your creditors, reach out to your service providers, and see what they can do for you. Again, with those rates being less, we want to capitalize on that. If it means that you can save $150 per month on your mortgage just for doing that, and you need the relief right now, go ahead and do so. But keep in mind, you're resetting that time frame. So now if you've had this mortgage for 2 years and you had 30-year loan, you've got 28 years left to go. Now you're starting over to say, I'm back at 30 again. So again, you want to make sure you really understand what that looks like for you. But with the Feds cutting rates, that should show up in our budget, show up in our buying power, and make things a little bit easier for us to borrow money and to get the financing that we need. Make sure you look at your credit report. Pull your credit report before you go and apply for financing to make sure you know what you are up against and what you qualify for. You want that the lower rates offered. So let's do the work. Let's do it on the back end. Pull the credit report, reach out to a counselor, and get things going in the right direction. If you've got any other questions, again, you can reach a counselor at 800-994-3328 or go online to Family Credit's website. All right, take care.